Yeah, I'm losing my
Yes,
head.
here's the risk and
futures.
reward of betting with Frank as your partner.
It's usually, when it comes to trading, it's usually pretty mechanical and good. The gambling on the Final Four in March Madness, not so much. But yeah, let's talk about risk and reward in futures here today, Pete. We got some good questions over the weekend from viewers who are loving the pairs trading stuff, the mean reversion stuff, but want to know a little bit about risk and reward in outright trades versus pairs trades and everything else here in futures. And so I wanted to talk about it because a lot of people come from the options world. And if you are coming from the options world, go check out The Leap, which is on our Small Exchange YouTube and on the Tasty Trade Network. There, it's guiding traders from options to futures. But I do want to talk a little bit about the risk reward in futures because options traders, a lot of times it's cut and dry, right? Like I bought this call for $1 and the market moved up, and so I made some money. Or if it moves lower, then I lose my dollar, right? Or like if I sell this option, I know that it's just the difference between where the market goes and the strike price and everything else. With futures, you're afforded leverage and capital efficiency similar to options, Pete, but where that market can go and what you can make or lose is a little bit more I would say murky, just because you have direct exposure. The market could move for or against you. So with that being said, let's talk about the small technology trade and build some foundation here in that futures are 50-50 trades that have equal risk and reward in both directions. And maybe, Pete, you can speak a little bit to this because this might be new to some people, which is like if you buy or sell a futures contract, the theoretical odds of making or losing money and that amount that you make or lose is pretty symmetrical in futures, right? Like there's no extra hoops to jump through when you're selling versus buying.
Yeah.
And we look at it as a 50-50 game, right? On both directions.
Right. Directional bet with static deltas, not with options, is a 50-50 bet. You're right. It's a flip of a coin. And I like the fact that so even with futures, since they're neutral securities, which means they're as easy to sell as to buy, unlike a stock where you got to go borrow that stock, you got to pay, I don't know, the hard to borrow stocks are a fortune, and then you got to pay the firm, and then there's interest. There's a lot of juice that everybody tends to take a little slide. So that makes a 50-50 bet right there against you. It takes the 50-50 away. It makes it 47-53 or whatever the cost of that. So here, at best, if you're just trading direction and with very little friction, or very tight bid offers, very low commission fees, you have that 50-50 bet. And that's always our goal, is how do we take that 50-50 bet, the binary outcome the futures give you. If you know what, they either go up or down, you're either long or short, you either make or lose.
And yeah, and of course, what we do here usually is look at strategy to make that 50-50 greater than 50% in your favor there. But yeah, it's nice to theoretically 50-50 trades here. And I view the dynamics around risk and reward very similarly. And it's really clean here in futures. And from like a theory standpoint, it's really nice to think about and look at, which is like the small technology futures. It's a $6,400 product, but the margin is very efficient and it's smaller than trading stocks and ETFs and options, in that it's only $550 from the small exchange right now. It's $550 though, Pete, to buy or sell, and that is equivalent for other stock products from the small futures and other asset classes like the small US dollar futures or the small metals. It's one margin that you're going to be charged for buying or selling, no extra price there. And with that in mind, Pete, that's where we usually like to set up that risk reward dynamic, which is, it's frustrating in trading shares of stock sometimes, Pete, because you could have a Tesla stock and you can have a Coca-Cola stock. Both are margined at 50 or 100%. So I don't know, given that number, what a good risk reward metric is. And most people would know there's greater risk and reward in Tesla than there is in Coca-Cola, even though I'm margined at 50 or 100% for both of them, like they're the same product. Futures margining, since it is dynamic and since it's so efficient with these numbers, I mean, this small US dollar product over $14,000 in size, only under $200 to trade because of that efficient margining. What that also does, though, Pete, is it approximates movement and thus approximates your risk. Maybe you can speak to how margin works and how you use it to approximate risk and reward in a given trade, like the small technology futures that cost you $550 to trade.
Right. And I think, you know what, you're starting at a good place where I get a lot of questions too, is that I see these two products have the same notional roughly, and the margin of one is half the margin of the other. Well, margin, and it's whether it's smalls or CME or ICE or wherever you trade, is all based on the same, what they call span model. And it is a model that takes into account the average of 252 days of movement and volatility. So you get a product that's twice, say you've got two products with the same notional, $10,000. One is twice as volatile as the other. You can expect that margin to be twice as much as the other. So if the one product had a margin of $200, the higher vol product would have a margin of $400.
Yep.
That's the function of the way the margin model works. Now, the question that's always asked me is, well, that's interesting. That's kind of an interesting piece, because what you're telling me is things that tend to move more have higher margin. And can I use that margin level as a get in, get out point? And you know what? It is a frame of reference of setting your metrics too high or too low. But no, it's not a substitute. It doesn't take away the decision making. Here we've got something with $500 in margin. We're certainly not looking for $500 of movement on each one of these trades. So it gives you some context in determining, you know, in a market that's moving a lot with a lot of volatility, that margin number will be higher. But what that tells me is I can't look for $30 or $40 in that trade. There's too much noise. So I will widen out my bands without getting past my comfort level.
That being said, though, Pete, I would say the margin is a great starting place for determining the potential reward you want to take and the potential risk. Because you look at the movement for 2021 here, which is just this, area right in here. It is pretty much plus or minus $500 around where it sits right now. It got up to $7,000 as a full notional product size, got down to almost $6,000 in full notional product size. It's splitting the difference. So it's plus or minus $500. Right there for the last couple of months, that is a good approximation vis-a-vis the margining, which is around $500. Now, what Pete just said there very eloquently is that we don't use that $500 margin level to say, oh, I'm looking to take $500 out of every trade. But for active traders who are used to, selling a call option and saying, I'm going to take 20, 30% of this, and that's where I want to get in and out, as opposed to few people, Pete, sell a call option or buy a call option and say, I'm taking this thing all the way to expiration, and I'm just either going to be in or out the full premium or whatever on that option. Most people that watch our stuff are active, and it's the same kind of thing where it's like $500 is the margin here for STIX. We look at maybe 10% of that, 20% of that, 30% of that as a good measurement of where I'm going to take my reward or where I'm going to take my risk if it goes against me. And it's a little bit different, though, for the pairs, which we've had a blast introducing people to. If you haven't seen, go back and watch some of our pairs trading content, because it's been a lot of opportunity in equities. So what you're looking at here, Pete, is two correlated markets that are similarly sized products, whether you have to ratio them out or not. And that often reduces risk. And what we've seen is, and this is just an approximation here, but what we've seen most of the time is about 50% of the movement in the pairs relative to those outrights. So what I would say here, from the broadest level to more specific with pairs, you're looking at futures. A good approximation of risk and reward is that margin value. Now, where you want to actively actually take profits or losses is a percentage of that margin value that you're comfortable with. And that's where the mechanics come in and you keep those consistent. Now with pairs, the margins are going to add up to a larger number usually. So what I would look at is just 50% of that outright margin and start from that base. So if you're trading STIX SM75, STIX has a margin of $500. I would expect in the pairs here about $250. And thus, if you're used to taking 10% of an outright, there around, $50 or $100 in STIX, I would take half of that with the equity pairs. So that's your risk and reward in futures from start to finish, the outrights to the pairs.